In Lesson 2, we will review the pre-approval process, lender due diligence, as well as automated underwriting systems. When reviewing a pre-approval versus a pre-qualification, I typically start by asking the class, do you know what the difference is? And most people don't know what the difference is between a pre-qualification and a pre-approval because the terms have been interchanged for so many years. A pre-qualification is a pre-approval without the validation. So we gather the information from the customer for the application. We fill in all of the blanks, answer all of the questions regarding income, assets, credit, how much do they have to put down. So we gather all that information, but in a pre-qualification, we have not validated that information yet. So we have just done a verbal verification of the income, a verbal verification of how much they have to put towards the down payment, but we have not been provided with bank statements, pay stubs, or W-2s. When we've completed a pre-approval, we've done all of those things. We've taken the application, we've asked all the questions, we've gathered all of the information, but in addition to that, we take it one step further. We do the credit check, we validate their 30 days of most recent pay stubs, we document 2 years worth of income history and validate the income to make sure that the income is what the borrower disclosed. And then we're also looking at those bank statements to make sure that they have sufficient funds to come to the table with. Additionally, we will be running a system called an automated underwriting system. And we're going to talk a little bit further about that in the next couple of slides. A pre-qualification versus a pre-approval. A pre-qualification is something that you're doing very early in the process with a customer. Maybe they're not quite ready to take that next step, or they're about 3 to 6 months out from even starting to shop for a home, but they're trying to prepare and make sure that they know that their credit's in good shape, or what type of a home they should be looking for, or in what price range. That's usually when we're going to look at a pre-qualification first before taking that next step to a pre-approval. But when you have a buyer that is serious and ready to start shopping right away, having that pre-approval just gives you the reassurance that you need to know that your lender has done their due diligence and validated that customer's information. So next we're going to talk about lender due diligence. What is lender due diligence? Lender due diligence I categorize into 3 steps. Understand, document, and validate. Understand means that we've asked the customer all of the questions. We've completed the application. But when we're completing that application, sometimes there are situations or circumstances that require that we dig a little bit deeper. So I'll give you an example. A customer says they collect child support income during their loan application, and they're using it as a income towards the allowable income that we can use for them to qualify for the loan. In a case like that, if we've got a situation where somebody's collecting child support income, then that means there's probably a divorce decree in there somewhere, or maybe there had been a divorce in the past. And it's important that when we're asking those questions that we know, okay, that triggers me to ask my next question. If there was a divorce, we would need a copy of that divorce decree to determine if there are any other terms that would pertain to the mortgage financing. So that takes us to our next step, which is document. So making sure that we collect the appropriate documentation that we know now the underwriter is going to ask for because we know this situation exists. And then we're validating that information by gathering the document, reviewing it, checking to see what the terms of the child support are, and making sure that it meets the guidelines. So when you are working with a seller and you're in a situation where you have a multiple offer situation and you get a stack of offers, what's one of the questions that you can ask the lender that has pre-approved the buyers that are making offer on your property? And the question that I would tell you that's acceptable to ask is, have you done your due diligence? So you can't ask the lender, what's their credit score? How much money do they make? You can't ask them any of those questions, but you can call that lender up and ask if they've done their due diligence. Did they take a complete application? Did they gather all of the documents? And did they validate the information to make sure that their borrower truly qualifies? So this is a great example of how you can use lender due diligence to your advantage. Automated underwriting systems, or AUS. Automated underwriting systems are part of a loan officer's daily practice. Every agency that we do loans with has their own automated underwriting system. Fannie Mae has a program called Desktop Underwriter, or DU. Freddie Mac has a program called Loan Product Advisor, or LP. And USDA uses a system called GUS, or the Guaranteed Underwriting System. Automated underwriting systems were established to blanket risk across all borrowers without any unconscious bias, okay? So this allows a system to determine and evaluate risk based on information and data only that is collected at the time of application. And so when we are pre-qualifying a customer, or when we're pre-approving a customer, we are gathering all of that information on that loan application, and we are submitting it through one of these three systems. And when we submit that information through the system, it is based on that loan application, that uniform residential loan application that we complete at the beginning. Now, if I do not, as a loan officer, correctly fill out that form, then the information that I'm putting into that automated underwriting system could be inaccurate, and my findings may be inaccurate. Now, when I submit this file through that automated underwriting system, it's going to provide me with one of three findings. And typically those findings are going to be accept eligible, refer eligible, or refer with caution. Accept eligible means that the automated underwriting system approves the loan, and as long as everything that we've submitted on that application checks out and validates to be true and correct, then the loan can be approved. If our finding says refer eligible, it's saying that, hey, there's a possibility that this loan could be approved, but as an automated system, I can't issue the approval. You have to have an actual underwriter review the file for further documentation and further review. Refer with caution simply means that. Refer with caution, we can't do this loan. You can submit it to an underwriter for additional review, but it's unlikely when you're getting a refer with caution finding that it's going to meet the criteria for the program and be approved. These systems, again, were designed to blanket risk across the footprint. So every customer's file, unless they're applying for a specialty type of loan that does not run through one of these systems, every file gets run through this system. And the eligibility is determined by the system or through a manual underwrite if it has to be referred. I know I didn't mention FHA as one of the automated underwriting systems, and that's because FHA and VA loans do not have their own automated underwriting system. Anytime we're dealing with an FHA or a VA loan, those loan programs are ran through either Fannie Mae or Freddie Mac's system, and they are designed to review the criteria as set forth through those government agencies. So the next thing we're going to talk about is PIWs. And I would bet that most of you don't even know what a PIW is, or have never had an experience with one. A PIW is a property inspection waiver. A property inspection waiver or an appraisal waiver is an offer for your customer to waive the appraisal for an eligible transaction. Appraisal waivers are issued through either Desktop Underwriter or Loan Prospector, Fannie Mae or Freddie Mac system, and they are approved through Fannie Mae and Freddie Mac's database that they have of over 50 million appraisal reports. Fannie and Freddie do somewhere between 60 and 70% of all of the loans issued across the footprint of the United States. And so if you think about it from the perspective of if 10 houses in a neighborhood sold, that means that Fannie or Freddie is doing 7 of those 10 loans in that neighborhood. So they have this huge database of all of this information on property values, purchase prices, and when you have a borrower who meets the criteria for a property inspection waiver, meaning that they're putting a little bit of money down, it's a minimum of 10%, but they're putting some money down on the home, and there is enough data that they have collected in that neighborhood that they can say, okay, this home is likely worth what the borrower is paying for. And so in our automated underwriting findings, we will sometimes receive a property inspection waiver. Now, I know some of you may have had this experience before, and the lender makes it sound like it's something that they're doing special for your customers. And that's not necessarily true, because this is how it is determined. It's determined through that automated underwriting system. Fannie Mae and Freddie Mac's information database is what compiles enough information to say that the property's value is supported, and so they're willing to bypass having a full appraisal done.